Welcome to the monthly Consumer Issues program hosted by Cornell Cooperative Extension of Tompkins County. On the second Thursday of each month, we're joined by New York State Assistant Attorney General Michael Danaher, who makes a presentation on a topic of consumer interest. Today, he'll provide us with an overview of the ins and outs of insurances. After his presentation, Mr. Danaher will answer questions that viewers have submitted to CCE Tompkins in the Zoom chat box. This presentation also will be available on the CCE Tompkins YouTube channel and will be broadcast next month on Mondays on Public Access Channel 15. Thank you for joining us today. And now here is New York State Assistant Attorney General Michael Danaher with today's program.
Thanks, Sandy. Good morning, everyone. Welcome to our monthly consumer issue program, as we're going to talk about the ins and outs of insurance. I know that it's not the most exciting topic that people would have, but important nonetheless, and we want to encourage all consumers out there to be wise and good consumers when entering the insurance market. Sometimes we'll say, oh, that stuff is all so confusing and I don't want to listen, I don't understand it. Well, we're going to try to make it simple as far as what's out there and the kind of things that we can do as consumers to protect ourselves, to avoid scams, and to make a good and appropriate buying decision for us. We're always challenging everyone during our Cornell Cooperative Extension sessions to be good consumers. That we hear about consumer rights all the time, but the one thing that we don't often hear about are consumer responsibilities. And we, as good consumers, have responsibilities to protect ourselves and to learn as much as we can regarding different purchases that we're going to make or solicitations that we receive. Most of us, including me, are not experts when it comes to insurance products. And it's interesting because insurance is one of those things that we usually need before we want it. Whereas other things that we purchase, we frequently want them before we actually need them. And so we have to think about it a little bit differently, because insurance is really something that we need in most instances for the major areas: auto, home, health, life. All these different insurance products are out there that we don't see a benefit to. When you go out and buy a consumer product like a computer, you say, man, I really want that new computer, that new cell phone. I want the newest cell phone out there. And we may not necessarily need it, but we really want it. So we will go out and get those things we need before we actually want it. Well, in this case, we don't really see the benefit, like turning on that new cell phone and seeing all the apps that we can get and all that, the great stuff that we can do with it. You don't see that with an insurance product. You don't say, wow, I just got the best auto insurance policy that ever existed. Look at all the benefits I'm going to get from it. You never hear people talk about those sorts of things. So, but when we need it, we are really happy that we have it. But we just don't see the benefit in having to shell out all this cash for something that we don't see and feel tangibly. So it's something that we really, really need to consider, and we need to make the best decision that goes for us. Think about, that new TV you want to get, and you can just plug it in and hook it up and we're good to go. But with an insurance policy, we don't know. None of us wants to spend the money on insurance because we don't see the benefit from it initially. We are really glad that we get it when we have it and when we need it. And consequently, because it's more of a need before a want, we don't usually spend enough time evaluating what our needs are as compared to what our wants are, and determine what the best product is for us, we need to still go ahead and do that. Let's first talk about, when we talk about insurance, you say, what is it? And a lot of people know what it would be generally, but we have to understand what insurance is and what it is designed to do, so that we don't get misled when somebody tries to sell us something that it's not what it is. Insurance is a product that is designed to protect us in the event of a financial loss. The root of insurance, the root word is insure. The definition of insure is to make certain, especially by taking necessary measures and precautions. So it's to protect us. Insurance coverage is a contract. It's a contract by where one party, the insurance company, agrees to indemnify us or guarantee us or protect us against a financial loss in the case of a specific peril or contingency, meaning it protects us if something particular happens, and it protects us from a financial loss if something should happen. So we have to first understand that it is protection. It is not an investment. Some scams that have occurred in the past, none that I can put my finger on in our local communities that has happened, but globally have heard that sometimes fraud creeps in where people are being misled that what is really an insurance product is being sold as an investment, somewhere in the nature of certain annuities that pay you a benefit in the future. We have to understand that what we're buying is the protection. And that's why it's difficult sometimes for consumers to say, I've got to get this type of insurance policy, because they never expect that contingency or peril to happen to them. It won't happen to me, but it happens to a lot of people. One product that was sold, and the product is still around, but it's not being sold as this anymore, are what were referred to back in the day as vanishing premium life insurance policies, which people were sold policies to say, hey, look at it, if you get this policy, after you pay it for 10 years, the premium vanishes. And that was sold misleadingly to consumers, because as it turned out, the premium didn't vanish after 10 years for various reasons. I'll get into it a little bit later about how it did that. I don't want to confuse it with the particulars of it, but it's important to understand how it was done. So it was kind of sold as a, hey, you pay this for 10 years, it's done. You've got this life insurance policy forever. And it proved out that that wasn't the case. Just as a segue, I actually had purchased one or two of those, but I understood the underlying part of it. And just to let you know, I've been practicing law for a really long time, and I've been in my professional career for a really long time. And I want to let you know that some of those policies I still have, and 30 years later, I'm still paying the vanishing premium life insurance policy. But I understood what was going on, and so it wasn't a problem for me. But there were many people who, at the end of that term, when the vanishing premium was supposed to expire, are still getting a bill for the insurance, and it proved out that they were misled. So It's not an investment. It's not going to make you money. It's to protect you, and that should be what you principally get it for. There are many different insurance products out there. We can name a whole bunch. Some are more obvious than others. The obvious one is everyone that owns an automobile and wants to drive in the state of New York must have automobile insurance, at least a minimum amount of automobile insurance. Again, it's insurance. It protects us for property damage and injury loss, including injuries that we might cause to others in the event of an accident. You must have a minimum amount of coverage. The minimum coverage doesn't deal with property. Now, the collision portion of your auto insurance policies is damage. You know, you back into something and you dent your car, you'll have collision coverage to protect that. And that you don't necessarily have. You don't necessarily need to have. Some people do, some people don't. If the car isn't worth much of anything anymore, and it costs you, I'm just grabbing numbers, by the way. When we have this talk, I grab numbers. It has no relation to reality as far as what the premium might be. But let's say a portion of the collision of your the collision portion of your automobile policy costs you $500 a year, or whatever it is, $500 a year. And let's say your car is worth less than $500. I know that's difficult in this day and age with the price of cars, but let's say your car is a clunker worth less than $500. It doesn't make sense to have $500 worth of collision insurance on your and paying $500 a year for policy that the car isn't even worth it that much. So that's one thing where you have to be a good consumer. You have to decide what and make that decision. Do I want to end the collision on my policy? I've had several cars in the past that I actually stopped putting. I had the collision removed on it because it just wasn't worth it anymore to pay that price for what I would get if the car were totaled. So that part you don't have, but you have to have some liability coverage in case you injure someone. You are required under New York law to have what is referred to as no-fault insurance policy. And the minimum coverages that you must have are $25,000 in coverage for one person that gets injured in an accident and $50,000 for multiple people that are injured in the accident. You must have that coverage. If you are operating a vehicle in New York State without insurance, it is criminal charge that you can face, as well as you could face the loss of your license. Very important to note, don't be driving around a car that's not have at least the minimum amount of insurance, or you will lose your license. And the Department of Motor Vehicles needs to have proof that you have the insurance. If you have canceled the insurance on your car and do not turn the plates in, that's considered to be an uninsured car. Even if you park it out behind the barn and don't operate it, if you have the plates on it, as far as the Department of Motor Vehicles is concerned, that car can be driven on the roads. And if they have noticed that you have not renewed the insurance was canceled, and you say, well, it doesn't matter, the car's just out back, I'm not driving it. As far as the DMV is concerned, you don't have insurance. And for every day that you don't have your insurance, you can be fined and your license can be revoked. And if you let it go on so long, license suspended, if you let it go on too long, your license can be revoked. And then you're an unlicensed driver in addition to uninsured driver. So it's even worse. So make sure that you have the insurance. Now, so you have to have the no fault. If there are serious consequences, those are serious consequences if you don't have it. But what you need to do is, again, it's insurance. It's covering you for my financial peril. So what happens is that the insurance company covers you up to the amount of the limits on your policy. So if you have the minimum coverage, and let's say you hit someone and they are seriously injured, your minimum coverage would be for one person who's injured, your liability coverage is $25,000. Here's the rub. If the person sustained very serious injuries, and let's say they sustained $100,000 in injuries, they had a terrible fracture in their leg and they had a long term of rehab and they're still not walking probably, that could be a lot of money in damages, pain and suffering. And let's say it's $100,000. Your insurance company covers you up to $25,000. That leaves $75,000 that's not covered. What happens to that? It comes out of your own wallet. So to protect you from the financial peril, what you need to do is sit down with your insurance professional and kind of figure out what assets that you need to protect, what income you have, and that sort of thing, and determine if somebody were to be hurt, do I have enough coverage that will cover them by the insurance company paying rather than me have to use my personal assets? So be a good and wise consumer. Don't stick with a minimum just because that keeps your premium down really low. You need to see what assets you need to protect, what assets you have, investments, house, cars, things like that. Figure out what it is that you have in this pool of money, bank accounts, all that stuff, what your income is, and decide how much coverage do I really need to protect what I have. Because ultimately, a person who recovers, the $100,000, they can come looking for what assets you have to cover that $75,000 difference that we've been talking about. So again, be a consumer when it comes to auto. We also know about a product out there that those of us that own homes all have, and that is homeowners insurance. What does homeowners insurance? Like an automobile, homeowners insurance has two general coverages, which is property damage. So if your house burns down, you have coverage protection from a financial peril, which is replacing the house, repairing the house. On the other end, there's a liability portion of your homeowner's policy that covers you in case someone is hurt on your property. You have some type of liability because someone gets hurt on your property. Again, you need to speak to your insurance professional to see what coverage you need. Banks, if you have a mortgage on your property, are going to require you to have certain coverages because they don't want to give you the money to buy the house. Let's say it's $100,000 and the house burns down. And then they say, okay, well, we gave you the $100,000 to buy that house. You still have to pay us back. And you say to them, well, the house burned down though. And they'll say, I don't care. I still gave you the $100,000. You got to pay that back. So the bank's going to insist that you have liability, insurance protection on the home and liability coverage too, so that the house doesn't get taken before the mortgage gets paid off. So they're going to require that. So again, you want to protect your house in case some damage would occur to it. I've had that situation happen in my house. We had the pipes freeze within the house itself that caused us to have to pay thousands of dollars to get the problem rectified. And I made an insurance claim and I had coverage for that. And the insurance company helped defray the cost. I had to pay some out of my pocket, but it wasn't a huge financial hit because I did have that contingency, that insurance product there that helped to protect me from that sort of thing. So you want to make sure that you have coverage. And again, on the liability side, if someone were to be hurt on your property, you want to have protection there so that if that person does get hurt, that you will have insurance coverage that would cover any financial damages that might result from that. Health insurance is another thing that we're all talking about. health insurance over the last 30 years has just skyrocketed in the cost. I'm shocked even sometimes. I'll give you just an example that my state health insurance that I have through through the state employer. If I had to pay all of it out of pocket, I pay some of it, but if I had to pay all of it out of pocket, the state portion of it is something like over $20,000. It's just crazy. I remember when I first joined the Attorney General's office, which seemed like a couple of weeks ago, but it was 23 years ago. I came from private practice where I had my own firm and I was paying it myself. And I had insurance that was very good, comparable to what the state had when I joined here. But the cost to me when I was paying it all by myself was about $5,000 to $6,000 a year. And now it's probably 6 times that, 5 times that at least, for that, particular types of coverage. So it's really expensive, and I understand that. And there's a lot of options out there that are available. Sorry about the ringing of the phone. There's a lot of options out there that people need to investigate, and there are great resources out there for those that are searching for products. One way to go is the New York State Department of Health website that can provide information on the different plans. I know that later in the year, we're a little bit different now because of what COVID did to us and everything about signing up or the open enrollment period of time, which is typically toward the end of the year. And there are so many options out there for who your doctors are, what prescriptions you're on and need to have coverage for, what other types of medical options are, and you compare the prices versus the type of plan that you're going to get. And I would encourage everyone to be a good consumer in scoping all of those different options out. You want to, depending on the coverage that you need for medical, hospital bills, those sorts of things, really, really need to investigate. And there are, in every county, they have people who can assist you in deciding, especially for older people who are just, deciding on Medicare Advantage plans, all those sorts of things. They really have health counselors that can assist people in trying to not make the decision for them, but to give them the information so that they can be a good consumer to make the decision themselves. And I encourage you to do that. I do want people to understand, though, let's talk just a real quick second about Medicare and Medicare Advantage plans. A lot of people should understand that they are 2 different things. If you get a Medicare Advantage plan, that actually takes you out of Medicare, but they, I think, unfortunately, have used the same name. But a Medicare Advantage plan is not associated with Medicare. It's separate from Medicare. So understand that. There were problems when Medicare Advantage plans first came out of people getting telephone calls telling them, and the name Medicare got dropped to the person, and the consumer didn't know that it wasn't Medicare. It was a Medicare Advantage plan. It was a completely different product, and they thought, a lot of people thought they were being called by Medicare and being sold these policies. They signed up for it. It wasn't something that they really wanted and needed for their circumstances. So if you're receiving telephone calls and you don't really understand what's going on, before you sign on the dotted line, be a good consumer and speak with someone who knows about insurance coverages and can at least guide you for what it is that really is being sold to you and whether or not it really is in your best interest. Because there's a lot of good Medicare Advantage plans out there. There are. And I'm not disparaging anyone. It's just that we need to be good consumers and understand what it is we're getting ourselves into. There's other types of insurances out there. Disability insurance. Again, disability to protect us in the case we become disabled, and that the disability policy will provide us with financial benefit during the time that we would be in a disability. Understand though, that in my mind, I've split them up into two groups again. There are group credit, disability credit policies, and then there's disability insurance. And oftentimes when you go to buy a car and you get a car loan, or you get a mortgage and you have a mortgage loan, you'll be offered an opportunity to participate in a group credit disability policy, as well as a group life insurance policy, to cover you for that debt. So I'll just use the car, but it could be the car payment or the mortgage payment. You could be offered this group disability policy or credit mortgage policy. What that is it will protect you in the case of a loss, that disability that prevents you from paying your mortgage or your car loan. And it only covers that. So if you get this, let's just use the car. Let's say you buy a car, you get a loan, you decide that you want, in case I become disabled or in case I pass away, I'm going to get the life insurance or a disability policy. That's fine. And you can do that. The thing that you need to understand is that what you're paying for is an insurance product that will pay off the rest of that loan. So if you get a car, you have a 5-year loan, you get the credit insurance, you pay on the loan payment, everything's doing fine, and you've paid all those months of insurance. Is usually it's put into your payment. So you make a one payment. A portion of it is to pay back the car. A portion of it is for the disability insurance or the life insurance. And you pay that amount, pay your $465.33 every month. And you get down to where you're at 4 years and 10 months paying this loan, where you've paid every month on time, and you become disabled, or unfortunately you pass away. What happens? You make a claim on that insurance, and the only thing the insurance will pay is those last 2 months payments. That's all. They'll just pay the last 2, and then the loan is paid off. You still have the car, but if your disability continues, there's no more money. It's just to pay off that loan. Same with a mortgage. You have the group insurance. You pay, it's a 15-year mortgage. You pay 14 years and 6 months, and you become disabled. The only thing that the policy picks up to do is pay the last 6 months. So you'll have paid all these premiums over the whole course of the loan and paid off, which is fine. And it provides you with that protection, and you get your mortgage, the rest of your mortgage paid off. And that's great. And the premiums for those group policies are somewhat less than what I would refer to as a straight disability policy. That is, you just go out to an insurance company, you get a disability policy, and it says, okay, for the length of time that you are disabled, you will receive a benefit of X number of dollars. Now, you can take that money and use part of it to pay the car payment, but you can use the rest of the money to pay your other bills. And then when the car is paid off, but you're still disabled, you'll continue to get that payment every month for the length of time that you're disabled, or as long as your disability contract is out there. Those premiums are somewhat higher than the one we talked about before, those group health credit, or the group disability or life policies. But it provides you with additional benefit over the length of your disability. Or if you bought a life insurance policy, straight life insurance policy, and you pass away during the life of the loan, the benefit that's paid to you is the lump sum of the insurance policy. So let's say you buy a $20,000 life insurance policy. And you have a car that you bought, and at the same time you bought a life insurance policy, a $20,000 life insurance policy. And you pass away 4 years and 6 months into that loan, your survivors will go and say, hey, this person passed away, and the insurance company will issue a check for $20,000. And you can take whatever's left on the loan on the car, say you still owe $1,000, pay that loan off, and then there's still $19,000 that might be able to cover all the expenses or go to your beneficiaries. So they're two distinct things. And again, it doesn't matter which one that you end up choosing. The important thing I want to get across to you is there are different ones out there. Choose the best one that works for you. If you just want one that's going to cover the rest of the loan, and you don't care anything else, then you choose the disability credit policy, group policy. Or maybe you want to have a benefit that goes on continually if you become disabled, help supplement your income because you can't work or whatever. That's what that policy is. Make a good decision. There's other types of incidental policies that you don't frequently reach, but things to consider. Long-term care insurance. Nursing home care is very expensive. There are policies out there, obviously much cheaper the younger you are when you get them, but it can protect your assets in the event that you ultimately have to go into a nursing home. Cover all or some of the nursing home expenses, which can be $10,000, $15,000 a month for nursing home care. That if you don't have insurance to cover it, Medicare covers a short period of time, but after that, it's a private pay or Medicaid. And if you have assets, you won't qualify for Medicaid, and therefore you have to, it's called a spend down. You have to spend down your assets to cover that. So again, there's a product out there that can protect you, and depending on how old you are, it determines how expensive those long-term care insurance policies are. You just need to decide whether or not you would need something like that, investigate it, and make an informed decision. The other real big one that I alluded to a little bit already is the life insurance policies. Life insurance policies is to pay to protect. Of course, you're not going to be around anymore, so it's protect your loved ones in the event that you should pass away. Maybe you're the sole breadwinner of the family, and that you need to make sure that other members of the family are taken care of in case something should happen to you. So those insurance policies are out there to protect your loved ones in the case of death. Now, this is what I talked about when I talked about earlier about banishing premium life insurance policies. There are, again, two general categories of life insurance. There are hybrids and things like that, but there are two general categories. And one is called term insurance, and it's exactly what you would think it would be. It's for a term, it's for a period of time. Typically a year, you get a term policy, and so you're covered for that amount for the period of time that you bought it for, 1 year. So if you pay a premium, if you should pass away during that year, the policy will pay whatever it was, say $100,000 policy. You're covered for that year at that cost, and if something should happen to you, you proof of death to the insurance company, and the insurance company issues a check. Now, it's a new term every year. So if it's a term policy, you're only covered for that year. The next year, you have to pay a premium to be covered for the next year. And so if you think about it logically, as we age, there's a greater chance that the policy is going to have to be claimed. Just the fact of life. And consequently, if you have a term insurance policy, the older you become, the more expensive it is, because there's a greater likelihood that the risk is going to happen, the event is going to happen, and the insurance company is going to have to pay out. So if you bought a $100,000 life insurance policy as a 15-year-old, the premium, the term policy, the premium is very small. If you buy a term life insurance policy as a 65-year-old, the premium is much more expensive. So there's those. The other type of policy is called a whole life policy, which, as the name expresses, it covers you for your whole life. So it doesn't end on a particular term. It goes on for the remainder term of your life, or till the end of the, some policies will stop at like 80, just because they ended 80. So if you, and so your premium for that policy, again, without any hybrids, there can be mixes in of term and whole life, that sort of thing, where the policy premium could change. But if you get it very young and it's a straight whole life policy, you really only have to pay that amount throughout the course of your life. And what the insurance companies do, and this is just the nature of insurance companies, they take in premiums, they invest the premiums, and hopefully with the investment of the premium plus with the premium corpus, the main premium itself, plus all investments that those premiums generate. When they get enough of these in and they invest it all, their hope is that they're going to pay out less than what they've taken in premiums plus the investments that they're able to generate. So thinking about the whole life policy, you pay a premium, $350 a year, whatever. You pay the premium. As a young person, you continue to pay the $350. Well, the insurance company, because you haven't passed away, they take the $350 and invest it. It generates income, and hopefully they do good investments. And so at the end, when you pass away, and hopefully it's a long, long time from now, they'll have invested money, and that $100,000 policy that you paid for at $350 a year, all the way through to when you pass away at a ripe old age, they'll have invested it, and they may actually have generated through your payments and through their investments more than $100,000. They make money, but you're guaranteed that your loved ones are covered up to $100,000 because you bought that whole life policy. And the premium doesn't change. Where in the term policy, it changes every year as you age. The whole life policy premium stays the same. And that's where, what I talked about earlier, where the fraud occurred. They don't sell it this way anymore. But what they did was they were selling these whole life policies as vanishing premium life insurance policies, because what they sold to us was, okay, we can get you $100,000 worth of insurance with a whole life policy at $350 a year. But if you pay $350 a year for 10 years, the premium will then vanish. You don't have to pay it anymore. People are like, great, I'll pay the $350. It'll end. Then I'll have $100,000 worth of insurance. What happened is, going back to what I talked about a few minutes, is when they projected that, they said, okay, you'll pay $350 a month or $350 a year. We're going to invest that, and it's going to generate 8% on average over that period of time. And you'll see that by taking your premium and then the 8% that it generates every year, at the end of 10 years, just by the money you put in, it's going to continually generate $350 a year in investment income, capital gain, everything. That $350 a year you put in caused this pool of money, and that pool of money will spin off enough so that you don't have to pay the $350 anymore. So what you see is, we thought premium ends. It's over. The premium didn't end. What happened is, theoretically, it was generating enough money that the premium was still there at $350. You just didn't have to pay it anymore out of your pocket. And what happened was, the insurance companies overestimated what the income would be. That 8%, it was not generating 8%. It might have been generating 2%. So at the end of 10 years, it did not spin off $350, and people had to continue making payments. And so that misled consumers, is what they believed. They thought it just ends. It doesn't end. It just that it was supposed to be paid by another vehicle, and it didn't. People were still paying them. And so there was a lot of litigation resulting from these vanishing premium life insurance policies, which because they were misleading, they were dissolved. Not dissolved, they still exist. Whole life policies still exist in it, and they were very valuable. Just to put myself in that story, I knew that was what was happening. I saw what it was in the estimates, and I understood that if it didn't generate 8%, I was going to have to continue making the policy. So I kept them, and I continued to keep them. But what ended up happening was that over a period of time, because I've been paying these things, it did start generating a lot of income, and I continued to pay those premiums. And what ended up happening is the actual face value of my policies have now increased. So if, let's say, I had a $50,000 policy before, I just continued to pay the $300 some a year, however much it was. And now when I get an annual statement from the insurance company, I don't have what would have been $50,000 in coverage. I now have $100,000 in coverage on that same policy. So that the income that it did generate actually increased the face value of the policy over a period of time, so that my loved ones are protected over the course of time. The important thing again is it's for protection purposes, and most importantly, that we understand what we're buying. And if we do, and we say, all I want is $100,000 at the end, that's all I need to protect, then you can choose which, and I only need to be protected until I'm 60, because after that, whatever I saved, I'll save. My family's already taken care of. The kids are all gone by then. I don't have to worry about it. Then maybe you buy a term policy that after you turn 60, you just cancel. So those are the types of things that you have to be aware of, falling back to be a good consumer. So as you can see, there's many different products and different risks that are out there. There are some insurance policies that you wouldn't think of them as an insurance policy because it doesn't tell you that it's an insurance policy, but it is an insurance policy because it does what insurance is designed to do, to protect you in case of a financial loss. And those are warranties. Those extended warranties, raise all your hands out there who receive those calls, those automated calls on your cell phones or on your home phones saying, this is so-and-so from some auto protection company. Your warranty on your vehicle is about to expire, and we want to offer you this product. I don't usually get past that part of it. It's usually hung up by that point in time. That's really an insurance product. Extended warranties for when you buy your vehicle and they ask you if you want to buy an extended warranty. That's an insurance policy. So if you buy the extended warranty, your standard warranty is 3 years or 50,000 miles or whatever it happens to be. But we can give you this extended policy that will carry you up to 7 years and 100,000 miles or whatever. It's just an insurance policy. It's to insure in case something goes wrong with that car after the 50,000 miles or 35,000 miles, 36,000 miles. 3 years, 36,000 miles was always the standard. They've extended it. They're larger now. For cars last a lot longer than they used to. But when you get to that mileage time period or that time period, 3 years, no more warranty. So if you want to be protected, the engine blows at 75,000 miles, and so you want to have coverage for that because you don't have to pay $6,000 to have your engine replaced. That's just an insurance policy. They call it a warranty, but that's an insurance policy. You go to buy something. I don't know about you, but whenever I go to a retail store and buy a thing with some type of extended life, let's say you buy a cell phone store, or you buy a computer. They always ask you at checkout, do you want the extended warranty for 2 years? It's an insurance policy that after your whatever typical manufacturer's warranty on the product, you can buy an extended warranty that will protect you in case the phone blows up after that period of time. You have to decide, what is the risk? How much is it going to cost me if I don't have insurance? How much is the insurance going to cost me? And is it worth it? As long as you know that, I can't say to you, oh, don't get this policy, don't get this warranty, don't get that warranty, it's not worth it. That's not what I'm here for. What I'm here for is to tell you what it is, and that you have to decide for yourself, knowing what it is it worth it for me to do that? So we need to be a good consumer. It comes into play in all things that we do. The first thing we need to determine is what we need. And again, you need insurance for certain things. What do you need, not what do you want? What risks are you do you intend to protect yourself from? Is it your loss of income and you need a disability policy? Is it the repairing of your home if you should have a fire or something, tree should fall on your house? How much do you need? And how can you protect yourself? Shop around for the best companies. There's different rating agencies out there for insurance companies. What's the best for your circumstances? What coverages do I need? How much do those coverages cost? And then you make a good decision. You know how much you're going to pay, and you know what you're being covered for. And then you'll go a long way to protect yourself. Make sure you choose what's based on what is right for you. Don't rush into purchasing something. Don't be forced into purchasing something or feel pressure to purchase something. If you feel those types of pressure, immediate red flags should be waving, and give yourself time to consider it and think about it. You can report any problems with insurance companies. All insurance companies must be licensed in New York State if they're selling policies in New York State, and they are overseen by the New York State Department of Financial Services, which is made up of a combination. Several years ago, the insurance department and the banking department were combined into the Department of Financial Services. And so they are overseen by that state agency. You could also report it to our office. If you need assistance, especially in the health insurance field, check with your local office for the aging to see where they can give you guidance to health insurance counselors. I think last time I knew in Tompkins County, it was Lifelong that might have been involved in the health insurance counseling, but I'm not exactly sure, but Office for Aging can give you that information. Our office on the health insurance side, our office actually has a healthcare bureau, and it helps New Yorkers navigate the healthcare system. And our office actually has mediators, a mediation staff that's available to help you with disputes regarding your health insurance carrier. If the carrier is not covering something that you think should be carried, or that their health insurance healthcare provider is not providing what you should have, we have or should get. We have through our healthcare bureau, we have staff that can assist you with those. So you can go online, very easily go online, or actually you can call our office and give you guidance to the healthcare bureau where they can provide you with that. There's Healthcare Bureau has a complaint form online you can fill out, and it will go into them. Correct overbilling, if you're being overbilled by a healthcare provider or something, they can assist you with trying to mediate those complaints. Maybe obtaining necessary medical healthcare and medications that it can provide assistance regarding that as well. So I would direct you to that. If anyone has any questions related to health insurance, I'd be glad to try and handle those. I know that that Sandy might have had some questions that came in that she wants to send our way, and I'd be glad to answer those. So
Great.
I send it out to you.
We do have a couple of questions in the chat, Mike. I'm wondering, you just mentioned the Health Insurance Bureau at your office. Is there either a web address or a phone number that viewers could
Yes, they
use
can go to the Attorney General's website, which is ag.ny.gov, and then look for the Healthcare Bureau, and then right on that page they can then fill out the complaint form or call and help to get the Healthcare Bureau to answer. And I think that when you call the general number, it may be that you get a list. If you want certain items, press 1, press 2. And I think there may be a Healthcare Bureau option there. If not, just call our general number, 1-800-771-7755. And that should ring in the nearest regional office, which would be Binghamton for those in Tompkins County. And we can direct people.
Wonderful, thank you. We do have a couple of questions. The first one is there any advantage to getting your insurance through a local agent versus an online broker, aside from keeping your money in your own community?
That's a really good reason. There's face-to-face contact. I think whether what product you're choosing and who you're choosing it from should be investigated by each consumer and make a decision that's best with them. Maybe they like the personal touch, where they can identify a face, they can go up and speak to somebody, and they can do that at a local insurance agency. Online, you're understanding you're dealing with somebody that isn't necessarily in your community, and you have to talk to them by email or a chat function online. And depending on whether you're comfortable or not approaching those questions online, and if you are, then maybe that's the option for you.
So it's a personal decision.
decision.
Great, thank you. The second question is about renter's insurance. With renter's insurance for an apartment, let's say you have 2 tenants, would each of them have to have their own policy, or would a policy in one person's name, with the cost shared by both, cover all the apartment contents? What would you advise in that kind of situation?
Yeah, I would advise talking to your insurance professional about what works best. The reason being is, let's talk about renter's insurance is no different than homeowner's insurance, except you don't have to protect the building, because the homeowner's insurance owned by the owner, the landlord, protects the building itself. Renter's insurance protects the renter's stuff, and it also protects the renter's liability. So if somebody gets hurt on the property due to the renter's fault, the renter's policy provides liability coverage for that. The property portion of the renter's insurance policy covers their stuff, their computer, their television, their clothes, their table, their couch. That protects their own stuff. So from a landlord's perspective, they shouldn't care if a tenant carries renter's insurance on the property side of it, because it's not the landlord's responsibility if the couch is destroyed. However, sometimes landlords would want there to be liability coverage because if somebody gets hurt on the property due to the being on the property, invariably the landlord will be sued as well as the tenant will be sued. And the way you can get insurance policies is you can get additional insured listed on your policy. So if you're the owner of the property, you can get your mortgagee, your bank, as an additional insured. So the bank is protected up to the amount of their mortgage, and they're actually listed as an additional insured on the policy. So if a tenant gets a policy and it's liability, the tenant is protected. But they could also, depending on the cost, have their landlord named as an additional insured. Likewise, the landlord could have his or her tenant named as an additional insured on the policy, depending on the type of product there is. So going to the question itself, two renters, unrelated, roommates, 2-bedroom apartment, and they get roommates. One tenant has their stuff and another tenant has their stuff. They could do one of two things. They could each get their own individual renter's policy, or they could jointly go to the insurance professional and say, look, we're two different people. We're not related, but we want to get a renter's policy. And then the insurance professional can guide them as the best way to do that, whether it's a combined policy covering both persons' personal property, or if it is, they're going to get separate ones. And then what I would suggest, if the insurance professional suggested that they get two separate policies, and I don't know if they would or not, make sure that you're the additional insured on each other's policy, so that you're also covered under theirs and they're covered under yours for liability purposes.
That sounds like good advice. I don't think we have anybody else queued up here, so let me thank you, Mike, and for today's presentation. Mike will be back with us on Thursday, April 8th at 11 a.m. with a program on home improvement scams. You can sign up to get the Zoom link on our website at ccetompkins.org/events. Thanks again for your program today, Mike.
My pleasure. Thank you, Sandy. And hopefully we will see all of you in person sometime in the not too distant future.